Hello everyone and welcome to my channel. In today's video, we will talk about one of the most interesting tech companies around that has been trading on the Nasdaq, Nikola Motor. It has been one of the rising stars back in 2020 when the EV sector seemed to be on the edge of taking over the world. Obviously, this is not how things have played out, and today people are left wondering whether there is any possibility for Nikola to recover to its former glories. So, before the video continues, if you would like to see more stock analysis videos like this one, please remember to like, comment, and to subscribe to my channel. In recent trading sessions, Nikola's market activity has evolved around 63% of the mark, indicating a 18% decline from its value just 5 days ago. Despite the short-term dip, the overall trajectory suggests a relatively stagnant performance, with a 23% increase noted in the past month and a more substantial 75% downturn over the preceding 6 months. Given those dynamics, it appears probable that the pressure for continued selling will persist in the foreseeable future. The market is yet to identify the bottom as various possibilities are being tested. Nikola sets itself apart as a company whose reputation suffered a blow when its founder and former CEO, Trevor Milton, faced allegations and eventual convictions for deceiving investors and committing fraud. Despite grappling with considerable challenges, Nikola has surprisingly well weathered the collapse of the electric vehicle bubble, at least better than many other counterparties. Internal issues and disruptions in supply chains, financial constraints, and a general erosion of trust have compounded Nikola's challenges. Additionally, the company is notably influenced by the evolving investment sentiment, as safer and more predictable investment alternatives have diverted capital away from the equities. CEO Stephen Gursky recently expressed optimism, forecasting 2024 as a pivotal year in the company. While there may be something to that, in the sense that there may be some improvement compared to 2023, it's unlikely, however, to reach the heights of 2020 when the share price surged due to robust fundamentals or expectations rather, and widespread expectation for the EV sector as a whole. Despite the positive outlook by Nikola's management, it's crucial to acknowledge the substantial risk of insolvency ahead, currently standing around 80 to 81% according to macro axes, primarily due to cash flow issues. As things currently stand, Nikola is a penny stock and is trying very hard to sustain its relevance and to maintain its listing on the Nasdaq. Considering potential fluctuations in the upcoming month, I believe that there could be a niche for Nikola in some portfolios. With that being said, let's take a quick look at the technicals. The trading volume of Nikola has been around 56 million shares compared to the average volume of 121 millions. Over the previous 52 weeks period, the price fluctuated between 52 cents and $3.71. The volume of shares traded tells us how many shares are being bought and sold at any given time in the market, and if there's enough liquidity to support a trading strategy. If the float is too thin, it would be very easy to influence the stock price, but low liquidity could also mean that the demand is limited. When we compare the current volume against the average volume, there might be the possibility for trend reversal or breakthrough if the difference is too large. For instance, if the stock were to break through, the current volume would be significantly higher than the average volume. The market cap of Nikola is currently around $654 million. As we compare the current to the historical price fluctuations, the stock is 5% higher than the 1-month low, 5% higher than the 3-month low, and 22% higher than the 52 weeks low. On the options market, which often gives us a hint on the market sentiment about where the stock price could go next, the implied volatility is 135%, compared to the historical volatility of 124%. The put-call volume ratio is currently at 49%. It is normal for many stocks to have a higher put option volume than what they deserve because many institutional investors hedge their long positions by buying put options. The most recent options traded has been 11,000 contracts a day versus the 30-day average of around 45,000. For open interest, the most recent volume of open interest is 1.6 million contracts compared to a 30-day average of 1.8 million contracts. Regarding the shareholder structure, institutional shareholders hold about 24% of the total float, which is very significant given the scale and history of the company. The biggest shareholders include Vanguard, BlackRock, and Citigroup. Usually, it's best to see some institutional participation when holding a stock long term because it offers a layer of stability and token reliability in the medium to long run. It means that the market is confident that it will deliver value in the long run, which is a very important factor to consider for investors. I personally consider the minimum threshold to be around 25 to 30% for institutional ownership, although there may be many great exceptions to this as well. The current short interest is 18% of the total float, 50% of which come from the dark pools. If the short interest is above 15%, we may have arguments supporting the thesis of a short squeeze. It is a bit the case at the moment, however, we have to keep in mind that for Nikola, it's normal to have around 18% of short interest. Of course, analyzing securities from a fundamental perspective is always helpful, but it should be complemented with extra external forces at play. Investing in the stock market can sometimes feel like riding a roller coaster with its many ups and downs. This roller coaster may seem arbitrary if we compare the company's operational reports and its share price action. It is profoundly influenced by real-world uncertainties, central bank decisions, and many other intricacies between the real economy and the stock market. Even if the end result may differ from their participants, the stock market is deeply intertwined with the pulse of the world, and real-world uncertainties can significantly alter and affect its delicate balance. Events like elections and geopolitical tensions can often trigger fluctuations, leaving investors and citizens around the world alike on the edge of their seats. The mere speculation of a change in political leadership or a brewing conflict can cause stocks to sway, let alone when those speculations turn into the grim, dark reality. If the recent events have shown us anything from an economic perspective, it's quite obvious that the market participants will show less reassurance in the state of the local economy and the stability of our societies. Additionally, we must face the fact that the looming risks of a recession may cast a shadow on the market. When economic indicators hint at a potential downturn, investors may become jittery, leading to heightened volatility. It is crucial to understand that the stock market isn't solely driven by the cold, hard numbers, but also human emotions and perceptions that play a significant role in shaping the market dynamics. We can actually argue that our collective and subjective perception of the future is more important than the objective facts, and that our personal impression from the immediate surrounding can affect our perception of events that happen very far away. And within these immediate surroundings is the central bank, a key player in the financial orchestra. The interest rates set by the central banks have a profound impact on the stock market's rhythm, especially for exchanges like Nasdaq, where the tech companies often dance to a different tone. When the interest rates rise, the borrowing becomes more expensive, affecting the profitability of those companies. For the more speculative tech companies that often operate on the thinner profit margins, or in fact, negative profit margins, higher interest rates can be particularly challenging. Investors may reevaluate the risk associated with those companies, leading to sell offs and increased market volatility. Conversely, the lower interest rates can create an environment conducive to borrowing and investing, potentially boosting the stock prices. One perplexing aspect of the stock market is its ability to march to its own beat, seemingly detached from the real economy. While the economic indicators may point to a struggling or booming economy, the stock market may tell a very different story. This divergence becomes particularly apparent during periods when the real economy is faltering, yet the stock prices continue to rise. This phenomenon can be attributed to a variety of factors. Central banks' interventions, government stimulus packages, and investors' expectations can all contribute to this disconnection. It's essential for investors to recognize the fact that the stock market is not a perfect reflection of the real economy. It is rather a complex system influenced by a multitude of variables. When managing all these complexities, investors are wise to exercise vigilance and to broaden their perspective. Looking beyond the fundamentals of individual stocks, it becomes crucial to consider the macroeconomic and monetary landscape. Understanding how global events, central bank policies, and economic indicators interact can provide a more comprehensive view of the investment landscape. Macroeconomic factors like the inflation rates, the employment numbers, and trade balances should be on the investor's radar as well. Likewise, when keeping an eye on the central bank communications and policy decisions, they can offer insights into the direction of the interest rates and the overall market sentiment. Above these elements, that are all individually important to consider, there is also another one: the idea or the concept of cyclic movement. It is one thing to assume that things will always come and go, the good like the bad, but it's quite another to assume that the next cycle will look exactly like this one. The current market may be towards the end of a super cycle that began with the collapse of the 2008 real estate market and the quantitative easing that followed. A massive amount of capital has been injected in the market for more than a decade, and this has played a significant part in the recovery and later the takeoff of the asset prices. These policies may not come back, and there may not be the same kind of recovery that we have enjoyed after the last market collapse. The past doesn't guarantee the future, and it is no different this time. So really, the stock market is a dynamic and intricate ecosystem influenced by an array of factors. Real-world uncertainties, central bank decisions, often arcane relationships between the market and the real economy all make up to what we see on the stock market. In this ever-changing landscape, investors should be well served by adopting a holistic approach that considers both fundamental analysis and macroeconomic perspectives. By staying vigilant and embracing a multifaceted view, investors can navigate the stock market with a far better understanding of the forces at play. So, my conclusion overall is that considering an investment in Nikola would be appropriate only for portfolios that are characterized by an exceptionally high risk appetite and a certain capacity for handling volatile and risky assets. Although the present market conditions might offer an enticing entry opportunity, it's always wise to approach with caution and await additional support before committing more capital. In the current scenario, opting for short-term trading is advised over prolonged holding strategy. If you want to invest into an EV stock, then I would say that there are much better options in the financial markets at the moment. I would recommend to commit 0.5 to 1% of your portfolio in Nikola if you want any sort of commitment at all. and to split the allocation in 10 to 20% of the overall capital committed at a time to benefit from retracements.